What's up, everyone? It's Scotty with MoneyVest. So we've got lots to unpack in this market update, as today was quite an interesting day with the NASDAQ here selling off about 84 basis points. Of course, we had the S&P 500 down almost 1%, and the Dow Jones here also falling over 1% on the day on the back of some very hot inflation numbers. And not only that, not only the surface level headline inflation or core CPI, but also if you take a look at the Fed's preferred measure of inflation, which is the PCE, but also services inflation. And when you exclude for some rents and shelter costs from those services, which again has a pretty significant weight to the overall inflation, was also higher. And it's actually quite high when you look at the super core inflation, which is what the Federal Reserve and Jerome Powell has also mentioned in previous speeches. So all of that is going to be discussed and broken down in this video. As always, if you find it helpful and of course enjoy it, make sure that you drop a like and don't forget to subscribe to the channel. We're almost at 78,000 subscribers, so please make sure that you subscribe. And also do join our Discord and our Patreon if you are interested. There are some limited spots left, and there is going to be a link down below. You will have access to all the members-only private videos, including all the trade alerts and the trade ideas, as well as the beta access, the early access to the beta launch of the MoneyVest Pro platform very, very soon, where you can do a full fundamental and macro analysis on a lot of individual stocks, including the markets as well. So links going to be down below for a limited time with the discounted pricing. We'd love to have you on board. So first things first, let's break down the CPI numbers. Again, it was quite an interesting day with the markets being super volatile. We continue to see this type of price action here on the day, with actual numbers coming in at 0.4% month over month for headline CPI versus 0.3% consensus. Year over year, 3.5% expected. We landed at 3.5%. And ex food and energy, month over month, 0.4% was the number versus the expectations of 0.3%. And core CPI, ex food and energy, year over year, coming in at 3.8% here for core CPI versus expectations of 3.7%. So slightly higher than what the market was pricing in. And of course, for that reason, we did see a pretty reasonable sell-off. Again, a lot of consolidation sideways, back and forth here. And the NASDAQ was not able to break out over 438. That was QQQs. But of course, had a reasonable support at 436. And the SPY had a huge resistance at 515 and a reasonable support at 512. So that was kind of like a $3 to $4 range within which both the NASDAQ and the S&P were trading intraday. So lots of consolidation sideways. But I'm not here to discuss the actual CPI numbers. What I'm here to discuss is the super core inflation, and that is when you essentially account for services inflation, excluding for food, energy, and housing. So those are the three things which Jerome Powell has mentioned repeatedly. And this is what is really shocking, because Jerome Powell has mentioned this particular metric quite a few times, and he's also mentioned that goods inflation has been coming down, which is true. Prices of products and actual goods have been selling off, but services have been pushing higher. Services have continued to be very, very strong. So if you take a look at the super core inflation, a measure that shows the Fed may have a very serious and a real problem on its hands. Along with overall inflation measure, economists also look at the core CPI, which excludes for the volatile food and energy prices. By the way, we went over the energy prices earlier. I had a whole live stream going over the CPI numbers, and we talked about how energy prices are going to be a bit of a problem considering how strong the overall crude oil prices have been over the last 4 months. So this was discussed in our previous videos. So it's not a surprise why energy was up month over month. And it's also putting an upwards pressure on overall inflation as well. But a super core gauge, which also excludes for shelter and rent costs from its services reading, takes it a step further. And Fed officials say that it is useful in the current climate, as they see elevated housing inflation as a temporary problem and not a good gauge of the underlying prices. But unfortunately, and this is where the crazy and the shocking part comes in, I'll go over a step further, where one inflation reading is at over 5.6%. Super core accelerated to 4.8% on a year-over-year basis in March. And this is the highest reading in over 11 months for super core inflation. So Tom Fitzpatrick, Managing Director, Global Market Insights at RJ O'Brien, said if you take the readings of the last 3 months and annualize, so just the last 3 months and annualize them, you're looking at super core inflation rate of more than 8%. 4%. 4 times higher than the Federal Reserve's goal of 2%. This right here are the numbers that I want to go over. So what we have over here is essentially the items, right? So special aggregated indexes. So all the indexes over here on the left. On the right, this column that you see, the first column, is essentially the weightage, right? The weighting on overall inflation. So basically, when you look at the overall CPI, how much of that is in these particular sort of indexes or the aggregates that we're looking at. So to give you a simple example, all items less food is essentially 86% of CPI. So in other words, to say another way, food is about 13.5%, right, of overall CPI. Because once you exclude for food, all items less food is 86.5%. So hope that makes sense. All items less shelter is 63% over here because shelter is over 30%, right? Shelter makes up over 35% of overall inflation. So that's why when you remove shelter, this number sits at 63.8%. So that's the weight. And this right here is the year over year number for that particular aggregate index. So that's what we're going to break down because there are some scary numbers over here, folks. So let's just break it down one by one. All items less food, 86.5 percentage points, sitting at 3.7%. So simply when you exclude for food, we're sitting at 3.7% on a year-over-year basis. All items less shelter at 2.3, which again is a little bit reasonable, much closer to the Fed's target. So shelter prices clearly are putting a lot of impact on overall inflation because if you simply remove shelter, we're at 2.3%, right? But if you remove just food and energy, but include for shelter, which is core, we're looking at 3.8%, which is where we ended up today. All items less food, energy, shelter, and used in cars and trucks, 2.6%. So again, 2.6%, significantly more reasonable compared to other metrics here. All items less medical care services, which is 92%. That's sitting at 3.6. And all items less energy, 93%. So energy only makes up over 6.8%, almost 7% of the overall weight in CPI. It's at 3.6% at the moment. Now, this is where the things come in. Now, I really want you guys to focus on services, okay? Services is where the real pain is happening. Services, less rent of shelter. This is the super core inflation, and it makes up for over 28%, so not a huge deal. Again, small weight, a third of inflation here for this index. 4.8%, accelerating a little bit higher. But if you take it a little bit step further, and that is services less medical care services, so including for housing and shelter, but just removing medical care services, and that's 57%, so that's 2/3 of overall inflation CPI weight. We're looking at 5.6%. That's probably the highest reading you're going to have on this chart, which is 5.6% on a year-over-year basis. Quite a scary number. And again, if you annualize it, we're looking at upwards of 10% for this particular index. 64%, which is 2/3 of inflation over here. That's going to be an aggregate of just services in general. And services inflation is at 5.3. Pretty high. 5.3 is high for services inflation, and that's, I think, what everyone's going to try to, this is exactly what everyone's going to be focusing on. Because if you look at housing, right, so if you come all the way down here and you look at housing inflation, which again is 45% here, so almost half of inflation, housing, 4.7% on a year-over-year basis. Pretty high number, right? So we are, in a little bit of an interesting situation where goods inflation is down. We are seeing some progress on food. Energy was picking up its weight up until last month, but of course now we're seeing 4 consistent months of rallies in crude oil prices, which is now affecting headline inflation. And then when you look at services, more specifically core inflation and super core services, less of rent of shelters or less medical care services, I mean, it's a nightmare. 4.8 to as much as 5.6%, and the Federal Reserve is really, really going to be scratching their heads to figure out what do they need to do to really kill inflation here, because it is by no means decelerating. And really, I mean, it's really important for us to also understand that inflation is not going down, right? When it goes from 9% to 3.8% as we see now, it's not that prices are down. It's not that inflation is down. Nope. It is simply disinflation happening, meaning that rate of increase of inflation is going down. The rate of increase is going down. not prices itself. It's a rate of increase that's been slowing down on a year-over-year basis. It's not until we actually see negative numbers like we do over here. A few times we see over here negative numbers. It's not until we actually see negative numbers that we can confidently say that, okay, there is some serious deflation and prices are going down. Prices go up over time. It's just the rate of increase changes and varies with time. And right now it is north of 3.8%. In some cases, well over 4 to as much as 5.7% as well. So an ongoing problem, CPI increased 3.5% year over year, above the Dow Jones estimate of 3.4. And the data pressured equities and sent treasury yields higher on Wednesday, which obviously is a big problem, and pushed futures market traders to extend out expectations for central bank's first rate cut to now September. At the end of the day, they don't really care as long as they get to 2%. But the reality is you're not going to get to sustain 2% if you don't get a key cooling in services prices. And at this point, we're not seeing it. This was Stephen Stanley, chief economist at Santander US as well. So this is what the markets did. Of course, there was damage because of the inflation numbers and more importantly, the yields pushing higher. So all sectors were red except for energy that somewhat did well, 28 basis points higher. Everything else was basically red. In the last 1 week, again, most sectors are down except for energy that's up slightly. And in the last one month, basically, we've got a little bit of a split market with, of course, some sectors pushing higher, energy leading the way, comm services coming in at a close second, and real estate, healthcare, all the sectors rolling over. Cocoa prices, rough rice, orange juice, and of course, volatility was higher with palladium and Russell 2000 selling off. Bitcoin just under 70,000, Ether just over 3,500. And this right here are the big expectations that have flipped now from 3 rate cuts. Now the market's only pricing in 1. And this right here is where we are expected to be. So 3 next meetings, the market are very, very high probabilities that we're not going to see any rate cuts. So we've gone from a March cut to a May cut to now a September cut, and now only 1 rate cut is what the market's pricing in. And then, of course, the next second cut expected in January of 2025, with final cut happening in April of 25 for us to be sitting at 4.5 to 4.75%. Look, the bottom line is that this is a very clear message that I have. I've been talking about this for some time now on the channel, gotten a lot of criticism, a lot of negative comments over the months that, caddy rate cuts are coming, whether you like it or not. Inflation is coming down. And we've been talking about this for quite some time. In Ray Dalio, we broke down Ray Dalio's analysis just a few months ago. And he talked about this on LinkedIn. He said that stagflation is a far more likely scenario right now than a scenario where inflation is lower back down to the Fed's target. And we talked about a simple analogy, how it's more difficult. It's significantly more challenging for inflation to come down from 4 to 2% than it was from 9 to 4%. A lot of people saw that 9 to 4% pullback in inflation and thought that, wow, this is an excellent recovery. We're seeing inflation come down dramatically. It's going to be, before we blink of an eye, it's going to be back down to 2%. It's not that easy. It's going to stabilize somewhere, and that's exactly what we're seeing right now. It is stabilizing. I'm not saying that it can't go any lower, certainly could, but the fact of the matter is that it's stabilizing a little bit, and more importantly, services, housing, shelter, those are some of the elements within inflation that are still taking their sweet time before coming down. And so for that reason, I think it's really important for us to keep a close eye on where inflation's going and what interest rate expectations are. Because right now, one interest rate expectation right now from the market, 1 rate cut, is, I think, reasonable. I think that's what the Federal Reserve may end up doing if things continue down this path, if inflation continues to be a bit of a problem. So coming over to volatility, so we were up over 5.6%, so a little bit under 16. And again, keeping a close eye on the VIX 18 to 20 level. Now, I got a very interesting comment earlier today that why wait for VIX to spike? Time in the market is much better than timing the market. Fair point, can't argue there. But the idea is different because everyone's got a different strategy and style of investing. If your goal is to simply invest in a very passive way, and this is a very, very basic and very consistent strategy, if your goal is to invest passively and into broad-based ETFs and index funds, and you want to dollar cost average every single week, every single month, whatever frequency works for you, by all means, do that and disregard everything else. Don't watch the news. Don't look at the markets. Don't look at what the VIX or the interest rates or the Federal Reserve is doing. Don't look at individual stocks. Simply buy and hold dollar cost average into broad-based index funds and ETFs at your frequency, you're going to do well, because that's how the last 100 years have done. It's a very consistent and a predictable way of generating wealth over time. The volatility, looking at the analysis, looking at, actively participating and understanding what the Federal Reserve is doing, where the volatility is, where the technical levels are, valuations and support and resistance, all that really helps us get a good mix and a holistic approach to both investing and trading. So I still invest, right, in VUG or SMH, into broad-based ETFs and index funds. There's nothing wrong with that. But volatility, I use this indicator to be a little bit more active for when the VIX is higher and it does spike. It gives me a very compelling reason to be more aggressive, right, to buy more heavily. So I'm still long, let's say 80% invested, 20% cash, and my cash level fluctuates between, I would say, anywhere between 4 to as much as 30%. So it fluctuates between 4 and 30% depending on market conditions, right? Sometimes I'm feeling overly bullish and optimistic when the markets are selling off and there's a lot of fear, and my cash position may go down from 25 down to 4% as I'm putting more money into the market. And some days and sometimes I feel not that great, right? Not that optimistic and not that bullish on the market. And I feel like I want to lighten up on some positions and de-risk and raise some cash, sell some calls, rebalance my portfolio back to my target allocations. And in those situations, my cash may go from 10, 12% to over 28, 30%. I might be having more cash sitting on the sidelines. So that's completely normal, right? That's completely okay. And I use volatility and VIX as a very good gauge to better understand when there is fear and when there is complacency, when there is greed, or when there is a lot of panic selling. So this is, again, a very important metric. You can use it, you can ignore it. It's really up to your strategy and how you view the markets. But for me, it's worked out really well. And every time we've seen the volatility higher, it's been a clear signal for me to start looking into some deals and some discounts into the market. So that's how I use it. 18 to 20 is going to be that first level, all the way up to 36 to 40. Ask any of our members, when volatility is high, we fire up some alerts, and there's a lot of alerts on buy orders that go out, because we understand that when the VIX is high, it's time to buy, and the markets will recover and they will reverse back higher, and the VIX is going to get crushed back down. And that's how it's worked until this time it's different. So until those forwards are spoken, we have seen this play out very, very well over the years. So going over to Bitcoin, pushing higher a little bit, up over 1%, just under 70,000. So consolidating sideways in that red rectangle at the moment. Ethereum here just over 3,500. So continues to consolidate sideways a little bit. Resistance is going to stay put at 3,600 with the support level at 3,000 for Ether. And then, of course, if you come over to crude oil, 4 straight months, back-to-back months of green. Next target and resistance at $93, $94 a barrel. So got to keep a close eye on where that ends up. And this right here is the mighty yields, the 10-year treasury yields, pushing up to over 4.5%. A very significant rally up over 4%. A lot of the yields, in fact, 1 year, sitting over 5.2, 3 months, 6 months, pushing at over 5.3, 5.4 almost. And then, of course, 2 year almost at 5%, 3 year almost at 4.8. So lots of momentum on the yields, which is obviously putting pressure on equities. And we are seeing a little bit more inversion of the yield curve of negative 42 basis points. So this is most certainly going to be putting pressure on equities as well. Now coming over to S&P 500, so SPX dropping almost 1%, so actually made a new lower low. So if you come over to this analysis that I did yesterday, we talked about S&P 500 on the 30-minute time frame, making lower highs and lower lows. You can see that we've got a failed breakout and a resistance, triple top resistance at the all-time high, and we continue to unfortunately make some lower lows. And if there is any momentum on the S&P tomorrow, let's see if we can actually get back up to these levels. That's going to be sitting roughly at 5,200. So this right here would be that resistance to keep in mind on the 30-minute time frame. But as I said earlier, we continue to make some lower lows here on the S&P, so the momentum is not that strong. In fact, we are actually now making a lower high and a lower low pattern. So this right here can very well be argued as a downtrending channel for S&P. NASDAQ in a very similar situation where it continues to somewhat make lower highs and lower lows. So this right here can be argued as a little bit of a downtrend. And again, we'll continue to monitor how the markets basically trade here. But if we do see some momentum back higher, we'll keep a close eye on the NASDAQ as a resistance at 16,300. So that's going to be that level to keep in mind if the NASDAQ does see a little bit of a pullback pushback higher, excuse me, pushing back to the upside. That's going to be a resistance to keep in mind. Now, going over to Apple, Apple was down a little bit over 1%, so still consolidating sideways in that range inside this green rectangle. The buyers are still present, I would say. However, continues to be oversold, definitely selling off on the RSI and the MACD. And of course, the L3 banker oscillator continues to see that selling pressure, but I'm kind of gearing up on a much better, more favorable risk-reward setup here on Apple. Of course, the first support level is still valid unless, of course, we break down further. And this would be a no-brainer trading point for Apple here at close to 150s in the future. Amazon on the day also pulling back a little bit after hours, down about 22 basis points, but still managed to close green. Resistance is going to stay put roughly at 188, 189. So this right here is going to be that level to keep in mind. A very strong momentum for Amazon, of course, overbought on the RSI, the MACD, and the L3 banker oscillator as well. Support level is going to stay put at 179, down to as low as 158 to as low as 143 for Amazon. Coming over to Tesla, and Tesla here consolidating sideways. Resistance is going to stay put at 177, 178. For Tesla, support level is going to stay put at 153. For the company, continues to trade inside this downtrending channel. I will be doing a more separate, more dedicated video in Tesla as always. So we'll talk about that in more detail in another video. Going over to NVIDIA. NVIDIA held up really well. So I did a video on NVIDIA earlier today. So make sure that you do check that out. But on the daily chart, you'll notice that it actually got bought up fairly well. We did mark out some moving averages to keep in mind. So the 50 SMA, I believe, was the one sitting roughly in the low 800s, and the 21 EMA, it still is breaking down. Now, the interesting thing about NVIDIA here is that once we get a breakdown, the stock price, the price action usually works in a way that it goes back up or comes back down to retest that old support or resistance, now acting as a resistance, and then of course selling pressure continues. So I'm not saying that there is going to be more selling pressure on NVIDIA. All I'm saying is that as soon as it broke down, it's now going back up to retest the 21 EMA at 876. If tomorrow or later this week it's able to recapture this 21 EMA, fantastic. We're back in the game. But of course, if it gets rejected here by the white line, which is the 21 EMA at 876, there's maybe more potential downside here. And the moving averages, next ones to watch, that's going to be 50 SMA, 50 EMA, kind of aligned at 810, 813 for NVIDIA. Talking about advanced micro devices, still maintaining that support really well, 164, down about 2%. So this right here continues to be a very strong support level for advanced micro devices, all the way down to as low as 151 for AMD. And of course, we got a huge resistance alongside those moving averages in the 170s and 180s for AMD as well. Talking about Meta platforms, and Meta here on the day pushing higher, surprisingly up on the day 0.5%. And this right here is actually going to be a little bit of a resistance again for Meta at 519, 520. Support levels kind of aligned with those moving averages, and also inside this green rectangle, the starting point at 475 to as low as 450s for Meta as well. Talking about Netflix, and Netflix here pushing higher. Resistance is going to stay put at 636. Support level, very strong support sitting here alongside those moving averages, as well as the low 600s for Netflix as well. Talking about PayPal, and PayPal here pushing higher. Next resistance and target is going to be closer to $68 per share, and support level is going to stay put at 65. So lots of consolidation sideways for PayPal. And again, we're seeing some momentum, some buyers stepping in. It's a really question of whether we get a breakout beyond that $68 per share level or not to see $76, $77 for PayPal. So that's going to be that next target to watch for PayPal here. Visa, on the other hand, continues to pull back 81 basis points lower. Resistance at 290, as we have already discussed. RSI, MACD, and the L3 banker oscillator coming down. This right here continues to validate so far. But of course, if it does end up breaking down below this level, unfortunately, the next target is going to be that 200 SMA in the 250s for Visa. Talking about Google. And Google here continues to be a little bit more on the overbought side. A very strong momentum higher to new all-time highs, breaking out to this huge resistance for Google in the 150s, which I'll go ahead and turn this level into a new support for the stock here. But of course, we'll continue to monitor how this thing trades, because it's trading at an all-time high, and it's also very overbought on the weekly time frame. As you can see, it continues to move higher. So there's very little upside, at least in the short term, very little upside with some decent downside potential for Google at these prices. Talking about Microsoft, and Microsoft continues to consolidate sideways, and the resistance is going to stay put roughly around $431, with the support level staying put inside this green rectangle for Microsoft. So a lot of consolidation sideways for Microsoft at the moment. And finally, we got Enphase pushing higher, surprisingly getting bought up here after being down almost 2% on the day. There's really been a lot of choppy price action for Enphase, lots of consolidation sideways here for this stock, with a massive support sitting in the low 100s and a resistance and a target back up to close to 138, 139 for Enphase as well. So last but not least, we got Costco pushing higher a little bit. It's got that falling wedge, support level getting validated at 711. Next target and resistance going to be closer to 749, 750 for Costco as well. So hope you all enjoyed this video and a complete update on the markets, super core inflation, a little bit more on the shocking side. We'll continue to keep a close eye on where inflation numbers end up being. Tomorrow's PPI numbers at 8:30 a.m. Eastern. I'll see if I can be live during that time as well. But really, it's going to come down to the FOMC and interest rate expectations from the Federal Reserve, and what they end up doing with interest rates is what's going to dictate whether the markets react positively or not. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like. I would really appreciate that, and subscribe to the channel if you haven't already. And again, the links to our Discord and Patreon is going to be down below if you want to join, and of course be a part of our MoneyVest community with limited spots left. And again, you get access to all the trade alerts, trade ideas, members only private videos, options alerts, and also the early access to our beta launch for the MoneyVest Pro platform as well. So always happy investing. I'll see you all in the next video.